This is Intelligent Investing presented by Fidelity Investments. U.S. stocks reached record highs in January and dropped over 10% in just 9 days, ending in early February. A recent note from Morgan Stanley argues it will be difficult for stocks to climb back up to record-setting levels from earlier this year. Morgan Stanley says January was the peak for sentiment in 2018 and possibly the peak for equity prices. They point out that gross leverage from their hedge fund clients, which is a good measure of the level of risk investors are willing to take, was at an all-time high in January and topped out right before volatility spiked, which forced investors to reduce risk. And according to Morgan Stanley, retail investor sentiment was more bullish in January than it had been since 2010 and has come down since that peak. But Fidelity sector strategist Denise Chisholm looks at the problem from a different angle. She analyzed historical corrections for clues about what could happen next. According to her analysis, there have only been 10 corrections this fast and steep since the 1960s, and stocks had positive returns in the 12 months following 8 of 10 of those corrections, with an average gain of 17%. Chisholm also points out that the sell-off was likely a response to high valuations paired with rising rates. But her analysis shows that if you look at the change in rates over a 6-month period and the market returns over the next year, sharply rising rates have correlated with strong S&P returns over the next 12 months. So, from a historical probability standpoint, there is reason to be optimistic on U.S. stocks following the recent correction. But from a sentiment standpoint, we may have seen the peak for the year.